Hi everyone, good evening. My name is Phil Weiss, I'm founder of Legal Hackers. Thank you all for coming tonight. How many people are here for the first time? No. That's not possible. It's like 90% of people. Okay. All right, so... Nice, okay. Thank you. So thank you all for coming out tonight. So we're here to talk about equity and non-equity crowdfunding, or we could just say crowdfunding if you'd like. If you haven't been, well, most of you have not been to a Legal Hackers event before, but what we do at these events is we explore and talk about solutions to issues at the intersection of law and technology. Crowdfunding is obviously perfectly suited for that sort of discussion, so we're very excited to have this discussion in particular at this particular time as well, because it's so relevant to so many people right now. Before we do anything else, huge thank you to our sponsors for making tonight possible, and I'd like to invite them to speak for a few moments. First, Harvest, who's provided the space for us. Lauren, you want to come up and say a few words?
Hey, my name is Lauren. I'm actually one of the organizers of Legal Hackers, and I was in this space for an event a couple months ago, and I said, you have to let us use it. So thank you to Harvest. They are a time tracking software company. I use them in my practice to track my billable hours. A very clean and easy to use user interface. And they've also been kind enough to extend to us a coupon code. So after a free 30-day trial of their time tracking software, if you use coupon code LegalHackers at checkout, you can save 50% off your first month. So thank you to Harvest for the discount and space. And I think that's it.
Is that up on the page?
No, but we'll send out an email or whatever, I guess.
All right, thank you, Lauren. And second, the beer is made possible by Plain Legal. I'd like to invite Michal up to say a few words.
Thanks everyone. I'm Nathaniel. I'm one of the founders of Plain Legal. We make it easy and effective for lawyers to practice law by providing software that automates client intake, document assembly, and payments. We're releasing our first tool tomorrow, which substantially saves lawyers time in preparing trademark applications. So if you'd like to be part of our pilot, you can sign up at plainlegal.com. And thanks for coming.
Thank you, Nehal. A huge round of applause for our sponsor. Thank you. So just a few announcements before we get started, and then I'm going to hand it off to Graham, who's going to give us a short presentation on the new rules around equity crowdfunding, which I think a lot of people here are here to hear about. First of all, we held a hackathon on February 8th and 9th of this year, just about 2 months ago now. It was great. Thank you all who came. There are a few people in the room who came. It was an absolute success. The winner of the hackathon for a whopping $1,000 cash was a company called GhostDrop, which is basically Snapchat for legal documents. It's a legal document transmission service that where the documents self-destruct after a certain amount of time. So congratulations to GhostDrop. Next Friday, April 4th, Brooklyn Law School is putting on a great event a la Jonathan Askin and Blip and Cube called From Bleak House to Geek House, Evolving Law for Entrepreneurial Lawyers. So this is going to be all about the entrepreneurial spirit of young lawyers in a, quite honestly, very terrible job market for them as they're exiting school right now. We'd love for you to attend. I'm going to be moderating a panel at around 1 p.m. around crowdsourced law initiatives and the tools to build those crowdsourced law initiatives. With that, I think we'll move straight into Graham's presentation. Again, thank you all so much. I'd now like to introduce Graham Travaligni, who's going to talk a little bit about the Jobs Act and equity crowdfunding.
Thanks. So just to give you a little bit of background about me, I'm a student currently in a third year at Brooklyn Law School. working with the Blit Clinic that focuses on legal services for technology startups. And I've focused a lot of my research and work this semester on equity crowdfunding, the proposed regulations, and actually I got the opportunity to work with the client and argue and meet with the SEC on behalf of some of the regulations. So spent a lot of time with the regulations, and I'll do my best to sort of give you some context, and hopefully that'll lend a lot of background knowledge to what the panelists will elaborate on. So as Phil said, this is actually a very interesting time to be discussing this and makes it all particularly relevant. The 90-day comment period for the proposed regulations just ended on February 3rd, and the SEC is in the process of sort of digesting those and incorporating them into what will eventually be the solidified regulations. So a little bit of background. Basically, the Jobs Act was passed in April 2012. Title III specifically pertains to the crowdfunding initiative, and the restrictions as they sort of emerged from the initial proposed regulations were for those with an annual income less than $100,000, they would be allowed to contribute $2,000 or 5% of their income, which is the greater of the two is sort of the limitation there. For those with a net worth or an annual income that exceeds $100,000, they're allowed to contribute up to 10% of their annual income or net worth within a 12-month period. So these restrictions are basically imposed by the SEC as far as what unsophisticated investors, what they identify as unsophisticated investors, and the limitations will be policed by these funding portals. So these funding portals essentially act as intermediaries. They resemble some of the non-equity crowdfunding funding portals that exist now. However, they have certain disclosures and will be required to make certain reporting requirements as per the regulations. So there are also some limitations on the type of companies that can participate in equity crowdfunding, as well as limitations on what they can actually do as far as raising money and what they must do if they reach certain thresholds. So initially, there is a restriction that no company can raise more than $1 million in the 12 months. And that's just essentially a cap for right now to limit the market and sort of not necessarily change the face of institutional investing. There will certainly be Series B and VC rounds, and initially that won't be replaced by crowdfunding. It's sort of just this opportunity to make initial capital investments in these emerging companies. It's essentially an expansion on the friends and family model that a lot of technology startups go through anyway. It just makes your friends and family pool a lot wider, essentially. Companies that are not available or not allowed to participate in equity crowdfunding would include companies that already report with the SEC, foreign companies, investment funds, companies that fail to meet the business plan disclosure requirements or annual reporting requirements, and companies that are otherwise disqualified by other SEC rules. So essentially they want to limit this to companies that are producing specific things. They can't just be housing investments or contemplating a takeover. They have to be real companies with tangible business plans and really sort of flush out some of these requirements before they're actually allowed to participate in the program. Furthermore, the funding portals will be required to make certain disclosures and sort of police the restrictions on the amount that can be invested and supervise the company's disclosures. So within 21 days, the offering statement needs to be made to the SEC that details the officers and directors of the company as well as owners and their percentage of ownership. There needs to be a risk evaluation along with a business plan. And for certain thresholds, there actually needs to be audited financial statements. So any company seeking to raise over $500,000 through the crowdfunding initiative will be required to provide audited financial statements. So these funding portals will essentially act as intermediaries, but there are some sort of specific nuances to the types of advice that they can give and also what they are supposed to look like. Essentially, they have to provide communication for the investors to sort of evaluate the profiles of the companies and communicate with each other about what might be ideal investments. However, they're not allowed to provide any investment advice on their own, and at the moment are not allowed to take equity in any company that they host. So this is something that has been a substantial critique of the proposed regulations by a lot of these companies is why not let the funding portals take equity stakes in these companies that they host? Certainly that would require them potentially taking equity in all companies, because the risk of them identifying specific winners, so to speak, and prioritizing them would sort of be an opposite of the regulations. But that's a hot topic issue. So without infringing too much on the panel's critiques, identified essentially some areas that I think, not only through the comments that have been proposed to the SEC, but some of the just general critiques of this initiative. And there's an argument that some of the reporting requirements are overly burdensome. And going back to the audited financial statements, this could be a $20,000 to $30,000 expenditure for some of these companies. And with a limitation of $1 million, that provides a substantial capital investment if they're already sort of in the hole against what they're raising in the crowdfunding initiative. It's also not necessarily something that venture capital firms would require of them. And this audited financial statement requirement would be in place whether or not they actually reach the threshold of $500,000. So this is something that companies are very nervous about and could potentially lead to them strategizing to raise $499,000 rather than go over the $500,000 mark. And it's just a hot issue for these companies considering this. The other thing is sort of the impact of the crowdfunding on the institutional investing market. Will it replace angel investors? Will it replace VCs? And how will the dynamics of institutional investing be shifted or relatively unaffected by these new proposed regulations? So with that, I'll hand it over to the panelists, and I hope that's enough context to sort of facilitate the discussion. Looking forward to it.
Are we allowed to ask questions or later on?
Sure. Yeah, absolutely.
Can you just line up? Maybe I did not hear.
Sure.
There. So you're saying the legislation.
Can you give her the mic?
Yeah,
so we
absolutely.
can hear. I'm sorry.
If I hear you correctly, so you mentioned the funding portal, they are not allowed to take the equity stake?
Currently, no.
So that means, say, for example, if like all this, like a Kickstarter or those crowdfunding platforms, so they are not allowed to take equity stake. But whoever did post the money, they can have the equity stake.
Yeah, so if you don't mind. So essentially, and the question was just about sort of the breakdown of the equity stake. The funding portals will act as the host for the company profile. And initially, I believe the SEC's projection was that there would be about 50 funding portals. There may be more, there may be less. I think that was just a projection, and there's arguments for limiting them. However, they'll just host the profile, basically provide an intermediary between the company soliciting the investment and the general pool of investors. And then it would provide access to all this information about the reporting requirements that they have, their business plans and things like that, and then actually allow you to make the investment. And the portals would be responsible for policing these caps on and then limitations on the investors, and as well as providing communication channels for investors to speak with each other. But it wouldn't necessarily be allowed to, or would specifically not be allowed to provide investment advice or prioritize any company over another.
So what's the business model really for?
That's sort of one of the interesting things of the regulation. So the question was about the business model and potentially monetizing these. There's the traditional sort of broker-dealer fee arrangement for these investments. There's also the possibility of selling the data if the portal is able to capture enough data about the market and about the company that they could potentially either sell it back to the company or provide sort of an interface for future companies to do some market analysis. But without the ability to take equity, it really does limit the upside and potentially limit the incentive to become a portal. So that's definitely one of the more hot topic issues that I've seen.
But I saw some portal they do take equity stake. Some already take.
To my knowledge, as of right now, it's
What was her, can you repeat?
Sorry, her question was just that she thought that some portals were able to take an equity stake at this point. To my knowledge, that was in the proposed regulations as something that they are not allowed to do, but a lot of these potential portals are fighting against right now.
You're thinking of, like, with sophisticated investors now, you can have portals that take equity stake, but that's not crowdfunding. I'll explain that.
Yeah, exactly.
Let me get into Charlie.
Okay, now is probably a good time to introduce our panel. And thank you so much, Graham, for that background knowledge. So, for our panel tonight consists of Nate, your last name, Nate Cotanch.
Cotanch, yeah.
Cotanch, nice. All right, who's head analyst at Rock the Post. We have Benish Shah, who's founder and attorney for Before the Label. Michal Rosenn, deputy general counsel at Kickstarter. And James Fanto, professor at Brooklyn Law School. Our panel tonight is moderated by Shezi Sardar, who is going to take it away from here.
Thank you so much, guys. Great intro, Graham. Very in-depth and comprehensive. You probably could have just been the panel yourself and knocked it out of the park. But it's an honor to be here. It's my first Legal Hackers event, and pleasure to meet the panelists as well. I just want to sort of open it up. I know we already got into some of the nitty-gritty details, burning questions about equity crowdfunding, but I wanted to just touch on a little more human concept. How did all of you sort of get involved in crowdfunding generally, or for Professor Fanto, your interest as a subset of your focus, and did you anticipate that crowdfunding would become as popular as it is, and on the precipice of the Jobs Act?
Sure, go start. Okay, let me see this. Okay. So I got started in crowdfunding about a year and a half ago, 2 years ago. We started to look at different crowdfunding platforms and noticed that fashion was something that was actually missing from there, and that's because it's traditionally a field that most people find to be a very risky investment. And also, to be honest, when you see all the amazing projects on platforms like, Kickstarter and Indiegogo, it's really hard to be like, let me support you for starting a fashion show when this person over there is like solving world poverty. So we took that, we tried to figure out what the best way was to approach that issue in fashion, and that's how we came up with the label, which is based on production-based crowdfunding. So it's the idea that you only produce what gets backed, and that way designers can actually predict forecasts and do trend analysis as well.
Nice. All right, cool. Well, my name is Nathaniel Cotanch. I'm with Rock the Post, and what we are a startup investing platform for entrepreneurs and accredited investors. So we are very much an equity crowdfunding platform, and we've been operating for about a year and a half to 2 years right now. And to elaborate a little bit on your question, I've been super surprised by the amount of interest that we've seen in the space and the implications that it has regarding the world of fundraising, entrepreneurship, beginning companies, and so forth, just in our about 1.5 years of operations. And we've actually only been in the equity crowdfunding space since April of 2013. We have been invited down to speak at the White House regarding the implications of crowdfunding. We've testified in front of Congress regarding the benefits of the Jobs Act, and we've attracted some pretty good interest from people who've joined our team. If any of you have ever watched Shark Tank, Barbara Corcoran has joined our board of directors, and it's just a really, really exciting space, and there's a lot of things that are going on in it.
I'm Michal. I'm at Kickstarter.
Yep.
I joined about a year and a half ago, and I personally thought crowdfunding was a really interesting concept, and Kickstarter definitely sees it as something that will affect a permanent change in the way that ideas or businesses in the equity crowdfunding are financed. And so I know from the company perspective, there is this aim of making this just an accepted new way of raising money. I think we're all a little surprised by the traction it's gained in the last few years and how mainstream it's gotten so quickly. But it's a nice thing to see.
Well, my name is Jim Fanto, and I'm a professor at Brooklyn Law School. And so, I mean, I'm not going to do any crowdfunding. I'm a professor, so I follow the development of the law. I study crowdfunding, and so far as I study the law, where it came from, and follow the regulations. So I think that's why.
That's an excellent answer, because it leads directly into my next question. As someone who is an expert of the law, a professor who is seeing the current trends as they are in crowdfunding, equity crowdfunding in particular, what do you see as some of the biggest challenges or hurdles, in a very sort of overarching way, that may impede it or derail it or not really create an ideal ecosystem for it?
Okay, so, professor, so I won't try not to talk too long, because, we tend to just drone on forever. But you have to understand, equity crowdfunding and the law, and, a lot of what Graham was talking about is in the law. You can complain about it, but you can't change it. It's in the law. So if I just back up for a minute, remember, this all came out of this view of Congress that we're not doing enough for entrepreneurs. Financing is too hard. So we're going to give them a break. We're going to give them different kinds of breaks. So it's Nathaniel, right? Yeah. So their firm, they say, well, let's do it in different ways. So we're going to make these sophisticated investors, we'll let them do a kind of crowdfunding, and that's already on the books now. It's what you were talking about before, that you can set up a portal as long as you have very well-to-do people. They can invest in the firm, the portal can invest in the firm. So that was part of the Jobs Act. Another thing, they said, okay, well, let's let companies raise capital in a kind of easy way up to $50 million. Well, that's part of the Jobs Act. And then kind of the last part was this crowdfunding thing where you're sort of limited by $1 million. But the kind of overarching thing here is this goes into a law that's been on the books since 1933. And we have, in that law, we have kind of two worlds. We have a world of kind of government regulation of capital raising, okay, for ordinary people. And that's what's called public capital raising, and it tends to be very expensive unless you're just, it's just expensive. And then on the other side is all this private capital raising that historically was, kind of small stuff with families, or it was with, so-called sophisticated people. And that's what the law reflects. Public, expensive, private, sophisticated. Now you have kind of crowdfunding among these other things stuck in the middle. And so you put that in, Congress put it in, but think about it, it's raising money from ordinary people, and I mean really ordinary, right? I mean, so that you could have people who don't have much assets and they can contribute. But it's not done through a regulated process, through the government's regulated process. So it's kind of an anomaly in the law. So that you say, oh, we're going to allow ordinary people to invest, not sophisticated people, ordinary people, but we're not going to go through a government regulation. And so that's kind of, I think, what's going on now, why there might be some problems, because Congress said do it, but they set it to the agency in charge, like the Securities and Exchange Commission, and they said, here, put it in place. With the Securities and Exchange Commission, they're sort of used to the two-part world, sophisticated and a public process that's expensive, and they're having trouble, and so they've issued these proposed rules, but the proposed rules, as you've said and others have said, they could be kind of expensive for an entrepreneur to, because you have to spend a lot of money telling people about yourself, getting auditors, so it's kind of expensive for $1 million. And then they came up with this funding portal, which is a new regulated firm, but it's not the traditional regulated firm, which is a broker dealer, and which is a kind of firm that's been regulated for a long time. So I think the part of the problem of what's going on and why we might have regulatory delay is we're trying to create some new animal, but the people who are helping create it probably don't like it. And it doesn't kind of fit in their model of how they think about capital raising, if that helps.
It does help. Yes, very much so. I'd love to hear Michal and Benish's perspective. You both are engaged with companies that are non-equity crowdfunding, albeit in very different ways, and Benish, you in a very specific industry. Do you see equity crowdfunding as something you may want to, or have your companies eventually incorporate? How do you what is your perspective on equity because of your current position being fairly non-equity?
Oh, sorry.
So, Kickstarter definitely doesn't have any plans to incorporate equity crowdfunding into its model. I think Kickstarter's fundamental mission as allowing creative projects to happen sort of undercuts that, undercuts any sort of motivation someone might have to go into equity crowdfunding. I don't know how much you guys have been following this recent Oculus news.
Yeah.
That's kind of a good lens through which to see this. So Oculus, which produces virtual reality hardware, it ran a Kickstarter project a while back. They raised $2.5 million around, and created these virtual reality headsets. They fulfilled. They ended up getting a few more rounds of funding from various investors, and then they just got bought by Facebook for $2 billion. There's been some backlash. There have been a lot of people sort of saying, well, Kickstarter backers got screwed. Why don't they helped this company come to life, and now they're not seeing any reward from the fact that Facebook just paid $2 billion for it. Missing from that analysis is consideration of some of the restrictions that the Jobs Act is proposing to place on equity crowdfunding. So for example, if Kickstarter allowed equity crowdfunding in a way that would allow backers now to sort of reap some reward from this acquisition, Oculus would have to set a $100 limit. They would have to explicitly state their goal of how much they're raising, and they would not be allowed to raise above that. They would not be allowed to offer the Oculus as a reward for backing it, which was essentially the entire reason that all of these backers backed, in addition to wanting to see this become a consumer product. So Oculus produced and fulfilled their dev kits and the Oculus Rift headsets, and the backers got that. They would not have gotten that had they been involved in equity crowdfunding, had they backed this in an equity capacity. So I think, not even considering the fact that beyond the Kickstarter campaign, there were then rounds of fundraising in which Oculus got much more money than they got in the Kickstarter campaign. So I think that analysis kind of shows you that there's a real difference in what each kind of crowdfunding is there to fulfill. What we as Kickstarter do is allow people to see a discrete project come to life, a discrete creative project. Here it was the creation of Oculus Dev Kits. It is not sort of the creation of an open-ended company for the most part. So,
well, I guess my decision for us to not go into equity crowdfunding was based on the fact that I did a very small stint with the SEC. This was back in law school. But I worked pretty much very heavily on Ponzi schemes. And in a lot of ways, I think it kind of like sets this example for you of how easy it is for, one, people to take your money and run away with it, or two, on the other, from the investor side of it, because I've been on the investor side before, it's, do you really want all of these people you don't know taking an equity stake in your company and then telling you, because they feel like they have a small percentage, how to run it? And from a CEO's perspective, that can get very, very hard. And with all of that combined, and when I look at the world of fashion, most of the people that we work with at the crowdfunding capacity, they're not business people, these are creatives. Okay, so their fundamental knowledge of business is it's on the lower end, and giving them, honestly, the headache of investors would actually be detrimental to their companies. So as we start to look at the way we want to do this, because our goal was to provide a much lower barrier to entry in the fashion world for these designers, we realized that if you hand them $500,000 because they were able to raise it, it would go a lot faster than they even anticipated, because they wouldn't be able to make the business decisions they needed to make. So that was our decision for it, and I don't think we're ever going to go the equity crowdfunding route at all.
That's interesting. There's obviously some I wouldn't say hesitation, but some reservations about equity crowdfunding on a very practical level in terms of the stakeholders or the clientele or the customers that both of your companies attract. Nate, I wanted to ask you, since you're working with Rock the Post, and you said it came into being in 2011. Is that right?
We've been in operation for give or take about 2 years now.
Okay.
So more toward middle of 2012, end of 2012 is when we really started coming to light.
And sort of how would you distinguish the perspectives you just heard in terms of equity crowdfunding being? Is it going to be a predominant way of raising funds? Has your company sort of sensed that internally? I'm sure you have a good knowledge of the market. We'd love to sort of hear your thoughts on how large of the pie sort of equity crowdfunding may take up.
Yeah, absolutely. So one thing I think that's very interesting to say, and as Professor Fanto has gone over, there are a lot of big challenges with the world of equity crowdfunding that's coming up. But having been in the trenches of helping run an equity crowdfunding platform for about 2 years now, I think what's very interesting from our perspective, and probably from a lot of other people's perspective who are running those platforms that you would today consider to be equity crowdfunding platforms. So, us, Rock the Post, AngelList is very familiar with a lot of people. WeFunder, companies like that, is that there is equity crowdfunding as you talk about it in the legal term. So you have the legal term equity crowdfunding, which is very much how it will be when it comes to light in terms of Title III of the Jobs Act. But then you kind of equity crowdfunding as we see it today, which we'll probably get more into in a little bit, but that's essentially operating under Regulation D, where we are working with a lot of companies who are raising seed, bridge, or mostly Series A rounds of funding. And these companies are companies who would traditionally go with the angel investment route or the venture capital route, which, I don't know if any of you have started a company and tried to go out and achieve funding, but it's just very, very hard and frustrating because you spend months and months trying to research investors who would even maybe or may not be a good fit for your company. You have to reach out to them. These investors have only specific periods of the year that they make investments, and they only make a certain amount of those per year. And it's just really, really hard to get in front of them. So overall, equity crowdfunding, as we see it today, and if the SEC does its job in regulating it to a light where it's good for everybody, then it will really democratize the process of raising funds for everybody. But again, to kind of back up a little bit, there's the term equity crowdfunding as you see it in terms of Title III of the Jobs Act, which deals with non-accredited investors and kind of the general public being able to invest in these private companies. But then there's this whole world that's been active for 80 years now with the Securities Act of 1933, where you're having strictly accredited investors that are able to invest in these private companies. And for the time that we've been active as an equity crowdfunding platform, that's what we've been doing. We have not been working with non-accredited investors at all lately, and only accredited investors are able to see the deal terms regarding private companies, unless that company is generally soliciting, which Title II of the Jobs Act, and I hope we'll get a little more into that, is just a really crazy world. So.
I suspect it'll get crazier once Title III is sort of in effect, with an emphasis on non-accredited investors. Like you said, Professor Fanto, it's really anyone who may not have the sophisticated knowledge of investing in a company. Should we be concerned that Title III will open up sort of a tidal wave of fraud or other issues where ordinary individuals lose their money? Do you think these investment portals, these funding portals, and Nate, you can chime in as well, would be able to do a sufficient enough job to protect both investors and the individuals that want to put in money?
Well, if you start talking like that, see, you play right into the SEC's probable hostility to this whole thing, which is a bit, and again, I'm not at the SEC, it's just my view, but I think it's kind of reflected in their rule proposal, but again, they're following the statute. And the statute said, well, if you want to do we say, we're all talking about equity crowdfunding, but what Nate's talking about is like, let's say it's sophisticated equity crowdfunding, which has become even more open, because he's saying, oh, you can advertise to the world as long as you just sell to the sophisticated people. Well, you say, okay, well, that's that world, but the statute says, well, if you do the true equity crowdfunding to mom and pop, it says, well, you have to provide all this information, the portals have to run in a particular way, et cetera, and there's liability built in. And I think a lot of the concern with, when people are looking at it, they say, well, how far will that extend? Because the company will be liable, but maybe the portals will be too. It may all turn on the portals, because remember the statute says that equity crowdfunding has to be done through a broker-dealer or through this new kind of portal, but it has to be done online. So you have to set up a portal and do the offering through, kind of an online device or marketplace. And so the question will be, whether they function, I think, and also I think someone asked earlier, well, how can they make money? Well, they make money they get paid by the company and companies. So I don't know, maybe we have someone in the audience, maybe we'll get to it later on. are there a few companies setting up, saying, well, we'll set up the platform and we'll do it for a number of issuers, and we'll get kind of an economy of scale, we'll set it up, and we'll be able to kind of deflect our liability by sort of investigating the companies somewhat and disclosing about them somewhat, and also policing how much people invest, and all that for what we get paid from the company, and also maybe offering information to companies about what their investors are like. And then maybe it can work. It's going to happen. I mean, Congress said it's going to happen. It's in the statute. The SEC can't not have it happen. So the question is, will the regulations just be so onerous that no one's going to do? But I think I've heard people say, oh yeah, we're going to set up the portal, the platform. And if that's going to happen, then it's going to happen.
Yeah, if I can. I think there are a couple of really interesting points here, and I think you hit everything right on the head. So basically, in terms of our understanding, the SEC has been around in their existence, and debatably their main purpose has basically been to protect investors. And the way that they've done this for 80 or so years is by not allow non-accredited investors and unsophisticated individuals to participate in this certain asset class of private companies, mainly because it's a whole industry where, the waters are kind of murky. There's not like a set terms of filings that every investor and company is obligated to file and everything and so forth. And they're just overall generally very, very risky investments. When you invest in a startup company, yeah, there's the potential for huge returns, and there's been a lot of studies that have actually showed that an investor who kind of allocates a little bit of their money to alternative investments and the rest to a traditional portfolio breakdown usually receives a little bit higher returns in that portfolio, just because alternative investments are not correlated with traditional markets such as the stock market and fixed income and so forth. But also another point which I think is very interesting too is if you look at it nowadays, as Bob Dylan said, the times they are changing a little bit, and basically that's in terms of education. You look 80 years ago and there was not really a good way for people to learn about this private company asset class and learn the benefits, the risks, and so forth, and can be completely versed into what they are getting into. But today, there are so many tools for people to be able to learn about private companies, to be able to learn what they're getting into. And overall, what we've kind of seen, and believe me, we've been dealing with a lot of people who are very accredited investors and have been running family offices and private equity firms for a very long time now. But what we've been able to see is that sophistication doesn't necessarily correlate directly with your income. So it's true, you have a lot of people who are really high net worth accredited investors, and they come to us and they're so excited about getting involved in this asset class and investing in startups. They know absolutely nothing about it. But then you have these other people who are non-accredited investors, and we don't know their income, but they're not accredited. And they are just very, very well versed in what they're getting into. You go out, you read a lot of TechCrunch, you follow a lot of industries, and it's just we found that sophistication does not really correlate with income. So.
And sort of what is the Nate? Just to follow up on that, your company is one funding portal. Maybe you could speak generally about this industry that's sort of cropped up based on the new legislation. To what extent do these funding portals take their due diligence? Is there some point where they just drop off and let the investor and investee sort of manage the relationship directly? How logistically involved does a funding portal get in this entire process?
Yeah, I think that's a great question. And the answer is that every funding portal, and funding portals, it's again a term, but it's not really fully in effect in terms of the Title III definition that you would think of a funding portal. So if you think of the equity crowdfunding platforms like us and like some other companies who are facilitating introductions and investments between accredited investors and startup companies, you have some platforms out there right now who either are registered broker-dealers or they are partnered with registered broker-dealers, and those are different from ones that have filed as investment advisors, and those are different from ones who have done neither. So, for example, for us, so to speak, we basically facilitate introductions and engagement directly between the entrepreneur and the investor, but none of the funds are directly filtered through us. We're not a registered broker-dealer at this point in time. But then you do have some platforms out there today that are partnered with registered broker-dealers, and when they're partnered with a registered broker-dealer and the people go through them and they actually raise funds and the funds are filtered through that platform, then they have to go through a lot more due diligence with that company and with their broker-dealer. So just to tell a little quick story about that, in early 2013, we were operating in partnership with a registered broker-dealer, and we interfaced with just as many companies as we do now. And to talk a little bit, just a brief statement about our numbers, since April of 2013, we've been working with over 100 companies. Many have come from great universities, great accelerators, and so forth. So we were in touch with all these companies earlier on in 2013, being in partnership with a registered broker-dealer. And this was actually kind of very frustrating to us because these companies came to us, they're very interested, they see the benefits of going out and raising funds with accredited investors and so forth, but they're startups, and again, this kind of plays into the concerns with Title III, but just to go through the due diligence that our broker-dealer required, they had to submit so much crazy documentation that you're a startup company. Being a startup company, you don't have years of audited financials, let alone any financials sometimes, and it just, going through that process, and they were just kind of stuck in a very old process of raising funds that's been around for 80 or so years. And we just found that going through this, it didn't really play into our philosophy, which we're out to try and democratize the process of raising funds and educate both startups and accredited investors to be able to positively take advantage of this new industry that's overall being created. But being in partnership with a registered broker-dealer and trying to do a lot of due diligence on them and everything, we found that it was pretty similar to just operating like a venture capital firm. We're not in the game to pick the winners, and I think a lot of venture capital firms have a lot of trouble picking the winners too. So.
Go ahead, you.
I guess from the perspective of a startup that was raising funds at one point, that's a really good point that you bring up. It's most VC firms ask for so much information from startups that it's irrational, honestly. Like, especially when you're early stage and that's when you need the money and you want to actually scale. All the information they ask of you, most startups don't even have that information. And I think while our platform doesn't do equity crowdfunding, as a CEO, I probably would put my company on an equity crowdfunding platform because you have the opportunity to tap into people who are non-sophisticated, but probably have a really good eye of what companies will work and what won't. When you look at a typical VC firm, what you're actually looking at is you're going to look at a bunch of analysts who are really just finance guys. Okay, they're graduates from really great schools, they're finance people, they've never been an entrepreneur in their entire life, they have no idea what it means, and so they don't actually know what companies to kind of let through the door, even though there are gatekeepers for it. And so allowing a lot of new companies to go on an equity crowdfunding platform, you're opening up that door for people with a real gut reaction and a real understanding of what entrepreneurship is to support those companies.
Could I just,
Definitely.
I mean, one thing that it seems to me to understand about this whole regulation of equity crowdfunding, for, again, the Title III for the people, is the way it's designed is to really be just a platform. It says to the platform, you can introduce companies, you provide information about companies, and then you also provide a place for people to talk about those companies. And what you cannot do is solicit investors, give people advice to buy this one or that one. See, and that's what Nate's kind of talking about. See, when brokers can do that, but they're kind of stuck. Because the law says, oh, you start recommending things to people, then you better really know about the background to a company. That's just their legal obligation. So when the brokers become involved, and you could have brokers in equity crowdfunding, but they have to be one step removed. But I think the whole idea here is that, no, you don't have brokers. You just have a platform, you have information, you have people talking to one another, and that's kind of it. That's kind of it. Now that flies in the face of what we're used to, but if it comes into play, that's it. And the platform really they can't take money, they can't hold the stock, it has to be done through other parties. All they can do is provide the platform for this communication. So you guys will tell me more, and you guys will tell me, because I'm older, that, is that going to kind of work? Will that work? And it may well. Because I think Nate's point is, hey, people, they're not rich, but they may know an industry, or whatever, better than someone who has a huge portfolio. So
So I guess on that note, Michal, as far as Kickstarter is concerned, as you mentioned, it's for creative projects and such. Do you see Kickstarter becoming a platform for very specific sort of industries? I know film has suddenly, blown up with Veronica Mars, and Zach Braff has a film on as well. Do you see sort of Kickstarter becoming a model for fan-based followings in terms of monetizing creative projects, and do you find that to be sort of something that's going to stay intact as far as certain industries are concerned, as opposed to equity crowdfunding?
Yeah, we've definitely seen certain communities really use Kickstarter's platform as a kind of conduit for people to engage with each other. What comes to mind most actually are gamers and certain product design communities. Also sort of niche categories of wallets and pens have huge for some reason on Kickstarter. But those communities have all grown and become stronger on Kickstarter. I obviously can't predict how it will evolve in the future, but we've seen them become stronger. We've seen them kind of, the actual communities, like the gaming community as it exists in the world, both video games and tabletop games. It's a very intense community, and they definitely have kind of molded their identity around Kickstarter. And I know our games project specialist, for example, was recently at a conference in Japan, and Japan is a huge site for gamers, and there is real clamoring for Kickstarter to kind of cater to these specific communities and to open up to creators in Japan, for example. And so I think it's been really interesting to sort of see how these specialized communities have made Kickstarter their own. And they use it in very different ways. And they use the comments pages, for example, on a particular project page to really engage in this dialogue, not only about that specific game, for example, or that specific film, but really about the kind of industry as a whole. So I think I do see that continuing, and we see, like you said with the film, as kind of bigger names in each industry start going to Kickstarter and turning to crowdfunding, it lends legitimacy and it kind of gives it a sort of staying power.
So on that note, I mean, I guess I would say, what's an entrepreneur to do? There seems to be an array of options here. You want to go the accredited investor route, maybe go to Rock the Post or a similar funding portal. Maybe you have such a network where you can do a private placement and do a 506 Regulation D approach, or Benish, maybe you can speak on this as an entrepreneur. I'm sure you can speak to some of the entrepreneurs in the crowd in terms of what strategy should an entrepreneur employ? Is it dependent on the industry or the product or the service or the network or your own comfort zone or disposition? I mean, how, from an entrepreneur's perspective, all of you are welcome to answer that.
This is a really funny topic for this. Just because I go back and forth on actually raising funds, and we've actually raised funds and then said no to them, so it's kind of weird. I think it's very industry specific as to how you want to approach it. Generally speaking, anytime you're in fashion, it's a really hard industry for VCs or any accredited investors to latch onto, whether you're in fashion tech or not. It tends to be because most people who go into fashion tech don't understand how the fashion industry actually works. They just kind of have an idea and they want to run with it. And because of that, kind of like anybody who's in it gets washed in the same color. That said, I think there are some just stereotypical things that hold you back as an entrepreneur, which is if you went to Ivy League school, if you happen to have very good family connections, and if you have a person in your family that's either a VC or an entrepreneur, you should go the VC route. You're fine, because you're going to find those connections. Everybody's going to give you a warm intro, and you're pretty much set. And it's always a good way to start it off. If you don't have those things going for you, which is a lot of other entrepreneurs who get rejected from accelerators for the same reason, I think for those people, equity crowdfunding is going to be a godsend, because you're actually allowing people who don't have access to suddenly have access. And that's an amazing, amazing thing, which entrepreneurs are completely lacking right now. And I think places like Kickstarter are great as a stepping stone to get to that point where you can get investment. But even with Kickstarter, a lot of it really, or Kickstarter or even before the label, a lot of it is still your network that has to kind of come in first before other people do. So, like I said, I think if you just have to look at everything you have going and what you might be missing in that category, and then make a decision from there.
Yeah, I agree with Benish that there are very specific industries that are usually catered toward one strategy or another. One thing I think that is really, really great about non-equity crowdfunding and is super interesting about that, and even has implications when you're raising funds through VC or equity crowdfunding, is that non-equity crowdfunding really reverse engineers the process of gaining market validation as well. So to tell a quick little story about this, we had a friend and he had this company, I believe it was called Pebble Watches, and we were speaking with him a while back, and he was going out to VCs, pitching them. He had a really, really great product, by the way, and he was pitching them left and right, and they were just telling him, we love the product, but we don't see the necessary traction that you have, and we just don't see the validation right now. So what he did is he turned to non-equity crowdfunding, Kickstarter, and he raised a decent amount of money through that, and everybody loved his product, and he successfully completed and I believe overshot his goal. And then what he did a little bit after that is he went back out to pitch to VCs and so forth, and he ended up showing them and being like, hey, we closed this Kickstarter, people love our product, this right here is market validation. And mostly because of that traction that he was able to show through a successful non-equity crowdfunding campaign, he closed a huge round from Charles River Ventures. So, you know, you have this process that's really reverse engineering of gaining market validation that you can show off when you are going to raise through that traditional angel or venture capital route, or if you go through that equity crowdfunding route, which, you know, has very similar desirables in terms of having good traction and so forth when you're dealing with high rounds of funding.
Yeah, I will just add that he more than overshot his goal. He has, I think, the most successful Kickstarter project in history.
Yeah.
He got $10 million, over $10 million
Wow.
of funding.
Wow.
And yeah, it is. And I think you're totally right. I don't have that much to add here, but I think you guys are absolutely right in terms of, first of all, certain industries being more suited for, or rather Kickstarter being suited for more industries than for specific industries within equity crowdfunding, and also this idea of kind of testing out your base before building an entire company around something. So kind of testing out the idea or your product or whatever form that product may take before building it into something larger.
And just a slightly more tedious question, actually, about Title III. I know, Graham, you mentioned the substantial burdens of the disclosure requirements that may come up in terms of tax, in terms of financial documents, perhaps getting audited or being required to audit. You know, are these sort of these prescriptions, are they going to, do you think, any of you, deter companies from pursuing funding under Title III? And if so, what would that sort of look like in terms of going forward? You know, how would the law be able to keep up or adapt to that?
Yeah, so after I say a few words, I think Professor Fanto could go into much greater detail into, you know, the specific challenges and everything, but there are a lot of challenges, and I actually did a really quick calculation this morning of just like, you know, basic forecasts and everything. So there's just a challenge in that, like, under Title III, are the costs of compliance, does it make crowdfunding too expensive to really be useful? So you take a company who hypothetically is raising about $300,000. There's some expenses that they'll inquire pre-raise, post-raise, and then ongoing. So some expenses that they will inquire pre-raise are, you know, their legal fees, their fees to require or satisfy some like the auditing requirements for the financials and everything. And let's say pre-raise, you'd spend about $20K. Let's say you go through this equity crowdfunding raise, you hit your minimum goal, and you get the $300K, then you would have, you know, the funding portal, if they're eventually allowed to charge a commission, and let's say that's about a 7.5% commission on the fund successfully raised. So out of that, you have about 22.5K. So just between pre and post fees, you have a company who raises 300K, and they only get about 257K of that when it's done. But then you take their ongoing fees, which are, you know, their annual financial audits, their annual disclosures that they have to have, their marginal directors and operators insurance, transfer agent, all that adds up to roughly, you know, around 80K and so forth. So when you would take all of these fees that a company has to go through just to, you know, satisfy all these challenges with the SEC, you have a company who'd set out to do equity crowdfunding with a 300K raise, and after they're left with 174K about, which is a little more than half of that. So that's a huge challenge, and, you know, that's something that I think we're all, in terms of equity crowdfunding platforms, really wanting to work with the SEC to kind of see what we can do to help that out.
You see, the problem is just kind of the regulatory structure we're working with. As I said, you always had these two systems. So the private system, where we talked about it as this Regulation D offering, but even in the private world, the law has developed so that someone has to provide information about the company, someone has to maybe audit the company, and that was often done by the people who were doing the offering, like the broker dealers, and it's kind of put on them. They say, here, you like dig out this information and require it from the company. That ends up being expensive, but that can work, because under Reg D you could raise an infinite amount of funds. But now think, you have this structure where you say you can only raise $1 million. And then you say, but you have to provide the information, you have to have the auditing. You're just following this regulatory model. And so I know when I first heard about it, and then when I read the regulations, I'm thinking, is anybody even going to use this because of the costs? But you kind of can't just go to the SEC now, the Securities and Exchange Commission, and say, well, ease up on the rules because it's in the statute.
Yeah.
So we'll have to, I guess the only hope we have, and I don't know if you guys agree, is that the portals will come up with a good enough business model where they can do a lot of that relatively cheaply. Now, it may mean there will only be a few portals that can really monetize this. I don't know what you think.
I just wanted to say I think it's very tough, and I think a lot is up in the air in terms of what these final rules are going to be for Title III. The proposed rules were pushed through. The commenting period ended on February 3rd. The SEC is reviewing the comments. Who knows when they'll push the final rules to the Federal Register, and then after that, who knows when it will be implemented. So there's just a lot of challenges to be going around, and I think everybody's kind of looking into it and thinking about how we can really innovate here and so forth. But in the meantime, there is that traditional Regulation D model that is pretty safe. So.
I guess from the bootstrapping mentality, it kind of gives a really good marriage between equity crowdfunding and traditional crowdfunding platforms, because you can actually do provability and marketability by first running a more traditional campaign, raise enough to be able to pay at least those initial pre-raise fees, then go do equity crowdfunding, and pay from there. Honestly, as an entrepreneur, when you go out and have to make your own money, 150 grand is way more than you had when you first started, even if your raise was 300,000. So if you look at it from that perspective and you build it into it, there is a very strong possibility to make this work for entrepreneurs. I don't think this is something that people should shy away from just because it seems cost prohibitive. Entrepreneurship is always going to feel cost prohibitive.
Well, amen to that. So, with that, I'd like to open it up to questions. So I'm sure many of you do. Yes.
So, I don't know how many of you guys know this, but equity crowdfunding is already going on. There's the interstate equity crowdfunding exemption that's going on in Georgia under their Invest in Georgia exemption. I was wondering what you guys thought of it, because it's a lot less rigorous than the Federal Jobs Act, and as long as, it's going to be in a couple of states, but Georgia right now, as long as you're a Georgia company raising money from Georgia residents, it's fine. And I've heard that there's like 24 companies that already got raised. There's already a platform called Spark Market that's done it. So I just want to know what you guys thought about interstate as opposed to a federal level.
Well, you always had that as a possibility. There's long-standing. There's an exemption built into the securities laws that says, well, if you just raise, from an in-state, but it's very narrowly read, it has to be a in-state company, and then you can only sell to in-state people, and you have to make sure that the stuff just stays in-state. It's kind of an old-fashioned exemption when capital raising years ago really was very local, but it's still on the books, and it's a possibility. I mean, again, if we're talking about $1 million, then, and you say, well, I just want to keep it local, maybe that will develop and say, well, it's a lot easier. And after all, I'm, as a first stage or as one among many. And I think you made a good point before. All this is equity crowdfunding, in-state, Reg D. They're not mutually exclusive. You see, you kind of do what you can do. You do have to be careful sometimes because you gather a number of shareholders, and then suddenly you say, uh-oh, I've tripped some reporting requirements, and I've gone into the big leagues just because I've raised so much capital. But they're not mutually exclusive. So it seems to me that who knows? That's kind of like this great example of, hey, the states compete with the federal government. They have something that works better, forcing the federal government to change. Any other questions?
I'm sure there's more.
How did you come up with that $80,000 operational figure? I'm just curious. Because it seems kind of high. I'm just curious.
Yeah, it was just all, disclosures and everything. So there's actually some estimates that were done by another equity crowdfunding platform that submitted comments to the SEC once the Title III proposed rules were pushed out. So this other equity crowdfunding platform, pushed out some of these comments. They basically just threw out some numbers, and I just kind of went with that.
Sorry, I've been following this for a while, so I have a lot of questions. But the second question I had, it deals more with just crowdfunding as it traditionally exists. So, I mean, I work in new media, and I work in film, so one of the things that I see happen, and I can imagine it happening to a tech company too, is that somebody will see a crowdfunding campaign on Kickstarter, say, that's a really great idea, I want to invest in that, and then they'll contact the people that are running the campaign, and they'll invest in the project. I was just wondering if that runs afoul of the public solicitation rules that the SEC has currently in place.
Oh, well, you want legal advice? Ask that again. What exactly you're doing?
So, so if you're basically running a crowdfunding campaign on Kickstarter,
right.
But then a potential investor sees it, learns about the project from Kickstarter, and then goes around the back and says, I want to invest in this. I mean, it seems like it's probably happened a couple of tech companies, but I know specific films that it's happened with.
Yeah, well, I mean, that, again, yeah, you could, if you don't fall within an exemption, then, and you're supposedly doing things publicly, then there's a chance someone will come after you saying, I mean, from the SEC's point of view or the regulator's perspective, they're always asking you, okay, what's your exemption? But again, they have to become aware of it. I mean, in the real world, they're not aware of all sorts of things, as we see from the Ponzi schemes and everything else, all the other kind of capital raising that goes on in the world. But yeah, I mean, but again, don't forget that the private capital raising today has gotten very liberalized, so that you can advertise to the world your capital raising, as long as you only sell it to certain people. So that's a huge, that was part of the Jobs Act, and that's enormous. Because it really means, you kind of don't have to worry about what you used to worry about, I've got to be quiet. I've got to be quiet. I mean, now you don't have to be quiet. You can put billboards up, internet, everything, as long as you just sell to certain people. And that's going to protect a lot.
Sorry, also, traditional crowdfunding platforms are product-based. Sorry, I'm usually very loud. Traditional crowdfunding platforms are product-based. So you're essentially almost quote unquote buying something. So you aren't actually raising money. You're allowing people to give you money in exchange for something else. So it doesn't run afoul of traditional SEC rules.
Yeah, no, I just wanted to basically say the same thing. Just because the company is raising on Kickstarter, it is a very different type of fundraise in which they're not giving out equity or you're not dealing with private securities. So just because the general public would be able to see that that company is raising on Kickstarter, that wouldn't, in the eyes of the SEC, signal that that company is using general solicitation.
Exactly, and then if a private investor is interested, obviously, in that company, he or she is obviously, allowed to reach out directly, and I would think Kickstarter probably has nothing to do with that. So, as the general counsel can attest.
Yeah, I go with that. So first, thank you to the panel. I found this very helpful. But a question from the perspective of investors. Let's say once this comes along and there's a exchange set up, what rights pass besides? I mean, how does it work out in terms of the rights then to the investors? I mean, from an entrepreneur's perspective, there's a lot of cats to herd, and in case there's like a motion, like somebody puts a claim for accounting, or there's a claim for you breached the fiduciary duty. I mean, just managing, in terms of a sophisticated company, I'm, managing now what is many different interests that may not be aligned and that now are part of your company. Is that how it works too? I just want to make sure I understand it properly, and then from an entrepreneur's perspective and in terms of the cost, to me that seems that's in a sense the more unknown cost, and how does that kind of get managed?
You hire really good lawyers. Like, I'm very, very serious.
Yep.
I know it sounds like a joke, but I am an attorney, but I'm not the attorney for our company. Shezi's are actually our attorney for that exact reason. Because,
Oops.
yeah, sorry.
Full disclosure.
No, but because you want someone to take a look at that, and you want someone on your side making sure that in no way at any point will that become an issue for you. Any CEO, any C-level at any company, they're besties with their lawyer for that reason. So anybody who's looking into doing this, just make sure that you have your like general counsel, conciliary, whatever you want to call them, like on board from day one.
But you make a very good point in terms of the demands thrusted upon a company that may have a multitude of shareholders. I mean, is that something theoretical, or is that something that could actually happen with a multitude of investors on board who may not be accredited? Or comments?
Well, you're not a public company yet, and doing like the Title III stuff doesn't make you a public company. Once you're a public company, then you have all this reporting obligations or what have you. So you're not a public company. You still have under Title III the obligation to give people information each year. I think more from the investor's point of view, it's like, how do I get rid of this stuff if I don't want to keep it? I mean, it's always it's liquidity, like when you make an investment. I mean, now maybe this stuff it's kind of like seed money, so I expect, you tell them, hey, this is your portfolio, not correlated with the S&P 500, so hold on to it for a while. But everybody cares about liquidity, but now that the portals can't have anything to do with. But we have a lot of stuff that's sold privately, and then it trades, where it trades. I mean, right?
Yeah, absolutely. And the other thing is, honestly, like if you're even outside of equity crowdfunding platforms, if you're raising like even a friends and family round, that's just as bad.
Right.
Because you know those people, and they know where you live,
Right.
And your like 8th aunt removed who gave you $100 really believes that she has a right to tell you how to run your company. It's the same thing. So it's not like a new like fear for anybody to have. It's always been there.
Other questions?
In terms of the actual portals or the platforms, from a technology perspective, are they very different in terms of features, functionalities? Is that something that you guys are investing on significantly? I would imagine security is a major issue for you guys. So just if you could talk a little bit about what you're doing from a technology perspective, I'd be interested.
Yeah, for sure. So I am not the technology person in our company. I do work with them very closely, but we do have a lot of measures to make sure that everything is completely secure within our platform. That's all from the technological end. I can't really speak toward the exact technologies that we're using and the ways that we're making it that way. But you brought up the question of different features that different platforms have and so forth. And different platforms do have very different features and very different verticals that we work with. You have platforms that are catered, equity crowdfunding platforms that are catered more toward consumer products and hardware. And you have the crowdfunding platforms that are catered more toward tech companies, health companies, B2B companies like us, and so forth. So depending upon the vertical that those companies work with, the features kind of reflect that. Given us, we operate in a very diverse sector of a lot of different companies, and we have a lot of features for investors because we deal with a lot of general wealthy individuals and accredited investors to come in. They tell us, hey, these are the type of private investments I would be interested in. This is the stage of company. This is the sector that I'd be interested in. And then we deliver companies that we're working with directly to them who we think would match them based upon their investment preferences. So it really depends, and again, I can't speak to the exact technological speculations regarding our security, but believe me, it has to be secure because if it's not, we wouldn't be in business. So we'd be in big trouble.
Any other points here?
I guess I'm not really familiar a lot, but I think from this I'm a little bit more confused. So so you're saying for any project that comes through, say for example Kickstarter, I'm an investor if I'm interested in certain projects. So if I invest, I wouldn't get any equity stake, right?
Yeah, so the way Kickstarter works is we don't do equity crowdfunding. You creators post some sort of creative project onto the site in one of our categories, whether it's a film, whether it's an album that a band is making, whether it's some technological product. And it's sort of donation based. We call it donating really, but yeah, you are not expecting any sort of return beyond the reward that you might come back for. So if there's a film that I want to support and I back for $50, I might get a credit in the film, meaning in the credits of the film, or I might get a T-shirt for the film. So it's rewards-based crowdfunding, and there's no equity stake.
Are there questions from anyone in the audience?
So if somebody is raising an equity crowdfunding round and they get investors from all 50 states, do they have to comply with 50 states of securities regulations and make filings in those states? Especially if it's a small amount of money that they're raising.
No, the answer is no. No, because you're doing it under the federal exemption, which then preempts the state ones. So yeah, otherwise it would be crazy. I mean, that being said, the states are concerned about this, and the states always have a possibility, if there's fraud committed against their citizens, that they can take action. So if something fraudulent develops, then they might say, oh, we'd like to step in. But no, you don't have to then say, well, do I comply with any kind of registration at the state level. That's like the thing he was alluding to before would be just like a state level capital raising.
That's, I mean, then on that, I mean, if you're doing a typical traditional 506 Reg D, and if you're soliciting in certain states, obviously that would not obviate the requirement to register under the blue sky laws of those given states. So that's just a wish.
Anyone else? Other questions? I think we'll have some time after for about 30 minutes or so to just talk and network and grab some drinks over here if you guys are interested. But let's give a round of applause to our amazing panelists. And also to our moderator who did an amazing job. And once again, we want to thank our hosts here at Harvest and our sponsor, Plain Legal, for providing some for you guys. So, yeah, thanks for coming. Hope to see you next time.